What is kind of the last piece of advice you would give our audience right now?
I would say do everything opposite of what the media is telling you to do. So
I love that one. Yes.
Good, savvy investors do the opposite of what the masses are doing. So if you're hearing there's going to be a real estate crash, but you really have the data showing you otherwise, well, then you're playing all by yourself. You're picking up all the apples, right? It's a very exciting time. So trust the data, not the headlines.
Hello, everyone, and welcome to another episode of the Jackpot Show, where we talk about everything relating to real estate, multifamily, finance, and entrepreneurship. So, and of course, not to forget land flipping. And today's guest is Kathy Fettke. Kathy is, a legend in the industry. She runs some of the biggest podcasts in the industry right now with the Real Wealth Show, the real estate news for investors. And she started her company, Real Wealth, in 2003 with her husband, Rick. She's also been featured on television frequently in all kinds of different channels, literally every channel you can think of. She has written a #1 best-selling book. Let's just start the show. Welcome, Kathy.
Oh, thank you so much. It's just great to see you. I've always had a lot of respect for you and your lovely wife as well.
What's happening in the world? What's going on in this economy, interest rate? Are we hitting a recession? Are we not? Where are we right now? Well, give us your expert opinion right away from the get-go.
Some people will say that we're already in a recession. Some people say that we're not going to have one at all. There's so many different opinions, and oftentimes we don't know until we look back. I can tell you there are certain industries that are absolutely in recession, and there are other areas that are not.
For example, which ones are in a recession right now?
Well, we know that office real estate is not probably something you'd want to be in right now. It's just plunging, and that's a tough business right now. I know some people heavily invested in office, and I'm glad it's not me. Let's just put it that way.
Yeah. I have a friend that invested heavily in real estate. I need to call him one of these days, but I'm kind of a little bit afraid of calling him because I'm afraid of what he's going to tell me. So yeah, yeah. That's true. So. Yeah, but it seems to be really weird that no matter what the Fed seems to be doing, we're still having positive net job months, net job creation months. So what do you make out of that?
Well, the way that I would interpret that data is that we are absolutely not in a national recession. We're not there right now when we have that many job openings. Just last month, the jobs report came out really strong again, and that means that you can't. I mean, sure, people can lose their job. Another industry that's hurting really badly is mortgages. Mortgages are way down. People aren't really that excited about refinancing from a 2% into a 7%. So mortgage brokers are hit hard. But in a recession, if somebody loses their job or their industry's having a hard time and they can't find another job, well, that's terrible. But if you can just turn around and apply for another job, there's been over 10 million job openings consistently for the past year or so. That's not a recession. We actually have, it feels like a runaway train that the Fed cannot slow down. So They've tried. They've been raising rates for over a year. Housing prices have not collapsed. Some people expected that, and you could go on YouTube and watch doomsdayers all day long, but it just simply has not happened. There's a lot of reasons for that. But if you asked me personally, and I think a lot of people would agree, we are absolutely not in a recession right now. And the Fed doesn't think that we'll be in one this year.
Okay. Now, do you expect one to come, or are we going to be able to wiggle our way out of this one more time?
Well, that is the big question on my podcast. As you said, I've got a couple podcasts, and I'm also on Bigger Pockets on the market. This is a question that comes up all the time, and nobody has the answer. And that's partially because we don't know what the Fed is going to do. The Federal Reserve is so much in control of where things might go next year. And a lot of people thought, hey, they're done. They're not going to raise rates anymore. They've been raising rates to slow down this runaway train, this economic train that is just, people out. They got out of their houses after the pandemic, and they are spending like crazy. They are traveling like crazy. They are not acting like they're in a recession for the most part. So a lot of people had believed, and the Federal Reserve had said that they would kind of get to the 5.25% interest rate where they are now. But in the last meeting, they said they will probably raise a couple more times until inflation is down to 2%. So that has shocked the market, and just nobody knows, because it depends. If they just keep hiking rates, that could be very problematic. That could lead to a pretty ugly, nasty recession. Here's the dilemma. When the Fed is using outdated tools, they're cost averaging, they're doing T12s for what's happened over the past year, and you can't be looking at that. We have to be looking at where we are now and where we're headed. We already know that rents have come down and they're stabilizing, but if you take the whole year and average it out, it's not going to look good. So why would you do that? Why wouldn't you just look at where we are right now, where rents are down? But that's not how they do it. So for the Fed to be able to get to their 2% target, remember, they have to average. And so they're looking at the past year and averaging where inflation's been at. And it's impossible, mathematically impossible to get to 2%, because you'd have to be below 2% to get to 2% on that average. So we know inflation's trending down. What they've done is working. Perhaps if they just held where we are, everything would be okay. But this fixation on a 2% inflation rate, when there's actually no mathematical way to get there unless you drive the economy into recession, that's what's concerning. So I wish we could all just have a little conversation with Fed Chief Jerome Powell, but I don't know if that's going to happen for you. Probably not for me.
No, not for me either. The other day, I'm like 100% agree with what you said. The other day, I got an update about the Phoenix rents, and I live in Phoenix, so I have my pulse on the ground here. I know what rents are and what they have been doing, and all of a sudden, I see like the rents, the rents are up 10%, and I was like, excuse me, rents are up 10%? Not what I've seen. Rents, I mean, in our property, rents are up 10% because we bought a 45 unit last year where rents were way below market. So we have to adjust it to market. But everyone that had market rent, their rents are stagnant, or in some cases, in some areas of town, they're going down a little bit. In some areas, they're going up minimally, but they're not there. But why is it reporting up 10%? Because a year ago, they were up 18%, right. And now they're down 8%, and as an average, it makes it 10% up or so. So that's how they calculate that. It's just completely crazy. But hopefully, they have some people. If more people like us speak up about it, and it's get watched by the right people, then perhaps it trickles up to the Fed, and they actually come a little bit to their senses.
You would think so, but unfortunately, when you saw how wrong they were about inflation, because they were using the same data when inflation had already taken off, but they were using, again, the past year as an average, which it had been very low before. We just come out of a pandemic. So they just, it's like, talk to boots on the street, see what's happening now. I get the point of averaging how performance over a year, but when markets are changing this dramatically after a pandemic, after you've shut down the economy, and then trying to make any sense of has not been stable. So taking 12 months in a very unstable time, it just to me makes no sense. But again, we have no control over that. So all we have control over is how we respond and how we invest and where we put our money and what data we look at. Right? That's all you can do.
And that's a perfect segue right into what I wanted to ask you. So with all of that turbulence and changes, where do you put your money and what do you do these days?
Well, I am an opportunist.
And give the audience perhaps a little bit of a background too. Again, I mean, I gave you an introduction, but there's so much more of that you have done since you started in real estate.
Yeah. I started the Real Wealth Network. It's just realwealth.com is where you find us. Started it 20 years ago. This is our 20-year anniversary. It was built out of desperation, I guess you could say, that I live in California. I didn't know that there was any other way to buy real estate besides negative cash flow. You hear people talking about cash flow, but us Californians only know the negative variety. So It wasn't until I started the Real Wealth Show podcast and started interviewing people like you, people that are real experts in real estate to understand, okay, there is this thing called positive cash flow, and it just doesn't happen here. So I've got to get really good at learning how to invest in places where there is positive cash flow. So I actually had Robert Kiyosaki on my show back then in 2005, and he explained to me market cycles and that, there was this huge debt bubble. And of course, I was a mortgage broker at the time, so I already knew that. But he said that those loans were going to reset in 2007, and that people needed to get out of the bubble markets, which were Arizona, California, Nevada, Florida. Those were just a few of the big bubble markets, and then take your money and invest it in Texas, where it hadn't bubbled up yet. But the foundation, the fundamentals were there: the job growth, population growth, and affordability. So I thought, well, hey, if it's good enough for Robert Kiyosaki, it's good enough for us. Rich and I jumped on a plane. I was a mortgage broker, as I said. That was back when you could have no money down loans, and I could write, it was unlimited. So I could just, we bought 5 houses that weekend, no money down. Just had to fill out paperwork back then. But those properties cash flowed. I talked about it on the show. Suddenly our phones
those were in Texas then, right?
In Texas, in Dallas, Texas. I talked about it on my podcast on the Real Wealth Show. Suddenly our phones were ringing off the hook of other Californians who wanted to discover this mysterious thing called positive cash flow. So then we started a business called, where we would help people find properties nationwide with the team in place to help you. So scary to invest out of state, but to have your property manager that's been recommended by other investors, to have your insurance company that's been recommended, and, just to have these resources that have been tried by others and tested by others. That became what we are today, the Real Wealth Network. We have over 70,000 members. We're still, to this day, helping people acquire cash flow properties. And because I've been through a downturn, I'm not a bit concerned about another downturn, because I know one thing for sure: most people prefer to live indoors and are going to need a place to rent.
Well, that's exactly right. So that's great. Thank you very much. It's a great little background and give some context there. So with that said, and with the vast experience that you have now, and having gone through this recession, and same for us with land flipping, we were fairly unaffected by land flipping. Our margins went down, and we had to change the method through which we sell. We used to do big land auctions where we would buy 250 pieces of land in 3 months and then sell them in one day. At a big land auction where we would put 800 to 1,200 people into a room and have like an auctioneer and just sell a property every 4 minutes. And it was great, thrilling kind of experience and very, very profitable. But in 2008, that didn't work anymore. We had to double, triple our advertising and to get a third of the people in the room, and the margin would just evaporate. But then we discovered that we could sell these properties online, our pieces of land. And that's when our business just transitioned to the other way. And that's led us to teaching and so on. But so we have gone through the recession, came out unscathed, but also actually profited from it by being able to buy when the prices were so low. So now that we are looking at this turbulence, my antenna goes up to see, like, where is the next opportunity? What is the thing that is closest to 2008, 9, 10, 11, when $200,000 houses? I live in Phoenix, one of the hardest hit markets in 2008, 9. Well, $200,000 houses were selling for $40,000. And at $40,000, exactly to the point of your comment about cash flow, at $40,000, it doesn't matter if that price goes further down or what happens to that house. Yeah. The numbers make sense. If you get $1,000 rent for a $40,000 house, there's no way you do not cash flow on that house. So we started buying as many as we could, but then the market fairly quickly accelerated from there again, recovered. And so now where's the next opportunity? Is it in houses again? Apparently not yet, or not right now. Is it in office once it drops enough? Is there opportunity? Where do you see the opportunity right now?
Well, we are just doing what we've been doing for 20 years and going into markets where there's job growth, population growth, and where homes are still affordable, where the average person can still afford the rent. And so we are probably more active than we've ever been. I launched a single family rental fund last fall, and we've been in acquisition mode aggressively ever since, because with this with this change in the market, it's a bifurcated market where you have people who are homeowners today who have locked in. The majority of homeowners today are in 30-year fixed rate loans, and most of them are in 2, 3, 4% rates. Today's homeowner is in the best position they've ever been historically in terms of their housing payment versus their income, because wages continue to rise even right now while their payment is fixed. So this idea that there's going to be a collapse in the housing market is just false. It's just people who don't really understand what's going on. Back in 2006, when, of course, we had a massive housing crash, you had 4 million homes on the market. Today, we have less than 1 million, and most of those are already in contract. So it's like less than 600,000 homes on the market. You go back to 2006, it was 4 million. We have over 25 million more people here today in America. Our population's growing, but we don't have the inventory. And the segment, the demographic of the first-time home buyer, the household formation age, the largest group of people today is between the age of 30 and 34. So this demand, massive, massive demand. There's 72 million millennials, and there's 600,000 homes available. So there's just no chance of a housing meltdown. Call me on it next year. Maybe I'm wrong. I can't.
No, I'm with you. I mean, I'm with you. I mean, the only way that could be, that both you and I could be wrong on that, is that if the Fed again drives rates so crazy high that we hit this massive recession, and now people losing their jobs and can't afford their mortgage anymore, and so many lose their jobs that basically supply of houses goes through the roof, while nobody wants to buy because interest rates are still at 8 or 9 or 10%. That could be a crisis that potentially could happen. But if that happens, I think even then the Fed will be probably very quickly reduce those rates again and rectify that situation. So then we're talking about a year like that, right? Not 10 years or something like that.
Right. I mean, that's what's interesting is generally, in most recessions, housing actually wasn't that affected. Just the one that people remember most and that was 2008. That was caused by greedy people all across the board who were lying on loans and, stating their income much higher than it was and who couldn't really qualify and were being qualified on a teaser rate, not the real rate. So when it adjusted, they couldn't pay. I mean, it's just couldn't be a more different scenario than that time. And that was a very rare housing crash. Normally, housing does pretty well, again, because it's stable. People have 30-year fixed rate loans generally. And especially right now when those payments are just so low, so much lower than if they had to lose their house and go get, rent something. They're going to pay much more in rent. So why would they? They're going to probably bring in renters. We didn't have Airbnb in 2008. Today, people can just rent out a room if they need extra income. So again, I don't see all these headlines about, oh, wait till you see the Airbnb crash. There's like 1 million Airbnbs. If every single Airbnb owner just decided to sell in the same day, it would be the best thing that the housing market ever experienced, because we'd finally be back to normal inventory levels and there'd be options for people, but the likelihood is not there. So don't believe the scary headlines. Housing is on the most solid ground it's probably ever been. But for investors, not so much. Investors who want to fix and flip properties, they're paying really high interest rates on that, right, on hard money loans. Investors who, you're seeing a lot of the what do they call them? The iBuyers that are out of the market because that system doesn't work. So for me to start a single family rental fund, we have almost no competition. We're getting properties for half of what we thought we were going to get them for. We're renovating for half of what we thought the cost was going to be. The rents are coming in higher than we thought. So right now, to me, the opportunity is an investment property because there's that competition's just not there like it was a year ago. Wholesalers, you'd have to bring them cookies and cake and like whatever to get them to bring you a deal because there were so many people who wanted it. Today, they're bringing them to us because we've got the cash and we can close. So I love being in investment property right now and also providing affordable rents, because as soon as rates went up, rates doubled last year quickly, almost overnight. And in doing so, going from 3 to 6, 7%, 25 million people were priced out of the market in that matter of months. Where do those people go? They still need a place to live. They're going to be renting. So whether you're in multifamily or single family, there's huge demand because of those high interest rates that are forcing people to rent. Renting is now cheaper than owning in many, many cities. So that's what people are going to do. Now, like you said, the minute the economy starts to, falter, that's when the Fed lowers rates and mortgage rates would come down. So you'd have millions of people that can now get back into the market. So I almost feel like if there's a recession, the housing market's going to boom, which it already is. There's already multiple offers right now.
Yeah. So great. So there's a lot to unpack here. Let's start with one area that is that you mentioned, that you buy these properties, the wholesalers come to you. So what kind of properties do you buy? Do you buy basically retail properties that are just need new carpet and new coat of paint, or you buy rehab properties at a discounted value to then go and put a whole bunch of work in there? So in other words, do you have crews that you work with, or you just buy basically nice suburb houses that somebody treated well and they moved out, and you just cut the grass and put the paint on and you rent them again?
It is a little bit of both. We are focused on the North Dallas area, specifically in the area where a lot of the chip manufacturing is going. You have billions and billions of dollars being invested in this area, kind of by Sherman, Texas, where just very high paid chip manufacturing jobs are coming. I don't know if you're familiar with the CHIPS Act that Biden passed, bringing manufacturing back to the US. And I think Arizona is one of the places where those manufacturers are going. North Dallas is another. But the difference is that in this area that we're in, we're buying houses for between $80,000 and $120,000. In some cases, they need almost no renovation. We don't know till we get them, right? But we budget about $30,000 to $40,000 for renovation. If when we close on it, it doesn't need all that work, then that money just goes back into the fund and it turns out better than we expected. But basically, our goal is to buy between $80,000 and $150,000 and put about $30,000 to $40,000 in renovation and be at a 1% rent ratio. We're overperforming for sure on that, because just one example is a wholesaler called while my partner, who's a property manager in Texas and it does have all the renovation teams and knows the rents really well. She was at the playground with her son when a wholesaler called and said, "Hey, I've got a house for $90,000. She's like, "Oh, I'll get back to you. I'm just at the park with my son." He goes, "Okay, $50,000. Okay, fine." It's those kind of deals. It's insane. So that's one thing we're excited about. Another area is build to rent. And that's got to be in the right market, because there's some overbuilding of build to rent communities. But we are also in that North Texas area.
Let's quickly explain what the 1% rule is, which obviously just for the audience, and what build to rent means. I mean, probably most of our audience knows, but just for the occasional person that still needs that comes in as Rilla said, as the first time listening to something like that. Can you quickly explain what that means?
Well, it's not a hard rule, but it's just basically the rents come in 1% of purchase price. So if you spend $150,000 on a house, your rent is $1,500. It's a metric. It doesn't mean anything, because one property might have high property taxes and high insurance, the other one not. So you have to look at, of course, the whole deal.
It's a good rule of thumb to it's a good rule of thumb that's well known in the industry forever. That basically says, like, if you're doing that, then you have a very high likelihood that after you pay your mortgage payment and after you pay property taxes and after you pay property management thing, you still have cash flow coming in. Because on a $150,000 property, the mortgage is not $1,500 a month. The mortgage might be, even depending on down payment right now, and the interest rate might be $900 a month. And so after adding a couple of $100 for the other things, you still have cash flow from that property, and you're in a safe environment that even if something goes wrong, you still can carry that property over for a long term.
And even safer, one step further, is that we are not actually getting financing. It's a fund, so we're raising cash from investors. We're just paying cash. Now we will refinance as soon as we get to a rate that we like, which we think will be coming this fall. And we will refinance the portfolio we have and take that money and buy more. Because again, the demand for housing is massive. The supply is just not there. So I think we're in the right place. So that's exciting too. But when we refinance, we're going to be able to take the after repair value, which means that we'll have all our money back out of it and reinvested, and we're just in it for the equity that we've gained from the renovation. So that's exciting.
Beautiful. Yes. Great. And then the other part is rent to own. Obviously, like just think I can, well, you can do it. I can do it either way. Go ahead.
Well, there's a lot of institutional investors, New York hedge funds that got into the single family rental business over the past 10 years. What they found over the last few years is there was hardly any inventory available. Everybody was fighting over property. So a lot of those institutional investors said, okay, fine, we'll just build these communities. We know that a lot of people would prefer a single family home versus an apartment if they've got animals and so forth. They want a yard, especially after the pandemic. People want their space. And so these hedge funds just came in and started building communities that look like regular subdivisions, but they're all rentals, or they might look like a townhome subdivision. And again, all rental, all under one management company. So there are some areas, I don't know them specifically off the top of my head. I think Atlanta might be one of them, where a lot of these hedge funds came in, and there might be an oversupply now of that. So we're definitely not in areas where there's competition. We're staying off the radar where the hedge funds don't go.
Absolutely. Yeah. Beautiful. So think about an apartment complex, just instead of you living on top of each other, you're living next to each other, because it's all either townhomes or small single families, more like 1,000, 1,200 square foot homes with a little backyard and your own garage, or at least your own driveway, and that on a larger property. So it's much more privacy. It's kind of has more the feel of a community, and still there's a community pool, there's a community gym, there's a community kind of some of these are gated and so on. And it's really a great idea that popped up. I think one of the first ones were actually built in Arizona, I believe, or alongside with a few other states, and it became really, really popular over the last 5 to 10 years. So great. So you're building some of those in that environment. I mean, if I would be a tenant, I would want to live in one of those much more than just in an apartment where I constantly have to worry about the neighbors partying at midnight, a floor above me. So makes sense. So you're building those, and now from a structure. Now, how big is your team to be able to do all of that?
Our team, we have 20 employees, but I also, like I said, my partners are property managers in the area who have the relationships with the builders, have the relationship with tenants. They've got a wait list of tenants and have the repair teams. So she's really the one with the systems. And also we'll be doing a fund in Tampa, same thing. They have all the operationals, and we are the investors. We come in and manage the investment side of it.
Okay, very cool. So you basically have a construction partner, basically, and a management partner, because that was my next question. When you're building up from ground up, one thing is like buying properties and having them fixed up and then rented, but building an entire neighborhood basically is a bit more involved. So how you handle that? But you answered that, yeah.
Well, the way is today a lot of builders are struggling because their debt has doubled, and sales may be down. Although actually the sales of new homes was up 20% this year, while the sale of existing homes was down 20% because there's just not enough existing. New homes are really what's selling, but there's still a lot of builders that are in trouble because their debt cost has doubled. So all we did was negotiate with a builder to take over his project and finish it out. So we're keeping that, him on, but we are keeping the project. So, there's deals that can be made today in this environment to create a win-win.
So with that's fascinating. So with in a situation like that, how do you find that? How did that deal come to you? Let's just talk about the deal where you took over the builders thing, because that's a brilliant strategy that I'm sure somebody listening said, like, great, I want to do that. How do I start cold calling builders, or is it just because you have this big network that these deals come to you, or how would somebody find opportunities like that?
Well, I think in this case, we are, the other part of our business is also working with builders to take 10% of their inventory as rentals for our members at Real Wealth who want rental property. So initially the relationship started as, hey, we see you're building property. We'd like 10% of it as rental. The rest you can sell retail. And that became a deal. And then he came back and said,
So
what?
That's a turnkey operation then, right?
Yeah, as a turnkey operation. But then once, things started for him, he was like, I don't think I'm going to be able to sell the other 90%. I don't even know if I can finish. In which case the deal was struck. He's like, okay, well, we'll just take the whole project.
So this is thing I have to smile because I've done multiple podcasts over the last few days, recordings, and there's a theme that comes up with every single one of them, and that is, at the end of the day, it's not about real estate; it's about personal relationships.
Yeah. Oh, yeah. So absolutely.
Yeah, we're all like, oh, well, I wanted to work in real estate, and I want to just like flip this stuff, and I want to do it from home. And yes, you can do that. And actually, that's probably one of our biggest. That was probably for us one of the best things and the worst things about land flipping. Because land flipping, you can absolutely 100% do without talking to almost anyone from home. So it's the introvert's dream of real estate. Huh? So Michelle, my wife, she's an introvert. She's like, I love this. I don't have to talk to anyone. If anyone, I talk to a couple of sellers here and there and so on, and that's about it. And you talk to a couple of buyers and so on, but you don't have to talk to a contractor. You don't have to negotiate. You don't have to, well, not negotiate much and so on. But the downside of that is that once we started in 2008-9, started lifting our heads out of there, we had built no relationships in the real estate industry. We had made millions of dollars with land flipping, but we had no relationships to banks because it was all bootstrapped and it was all cash. It was all profitable. We had no lines of credit. We had no bank relationships. We had none of these things built up for us. And in aftermath, if we had that, we would have been able to buy 10x as many houses in the downturn because we would just basically leverage our relationship. Now, obviously, we learn from that. Now we still flip land, but now we bank with different banks. We have these relationships. We have lots of lunches and dinners and things to network. We attend conferences and so on. So we have built that network. But that goes to the point that if for a lot of people think real estate investing is just real estate investing. No, it's a people's business, like every business out there.
That is so well said. And I cannot agree more that you've got to get out there. You've got to be a good person too, because
yes,
your reputation will precede you. And if you treat someone poorly, it'll get around. It's kind of a small world. So it's also a personal growth exercise and just being a good person, being in integrity. I've had people come to my meetups, to our Real Wealth events and say, just with this creepy vibe of, hey, I need to offload some properties, like, no, you're not going to offload your distressed properties to my sweet, innocent investors here. Like, don't be a bad person. There's a lot, there used to be, and probably still are, but there used to be a lot of people that would take advantage of others, in any industry where there's
of course they are
financial, right? I think real estate is less now because it's quicker to find out about these things, but also there's just so many backstops. You can check on the title to make sure you own the property. There's so many ways to protect yourself in real estate. But boy, when I started, there was a lot of snakes. I probably met all of them. So don't be one of them because they're not around anymore. Be a good person.
Well, they're not around anymore, but they were replaced by just as many new ones. So
maybe
they're still out there. They're still out there. We're dealing with one of them right now, but it actually is even known in the industry. But anyway, I second that. Be a good person. like reputation is everything. Like we just took over a 93 unit multifamily deal from our partner, who basically after a while the deal is not doing so well because it was hit by a hurricane and the insurance doesn't want to pay. So now we have to actually sue the insurance. But in the meantime, we have a property that has multi seven-figure damage to it.
Oh my gosh, I'm so sorry.
And our partner, who is supposed to be the person that has whatever, I think he basically threw up his arms, is like, I can't put any more money into this deal. So at this point, putting at risk his reputation, my reputation, our credit worthiness with the bank, our reputation with our investors, and so on. So I basically said, okay, great. I jump in. So we are jump in. Michelle and I jump in right now. We're putting $2.5 million into that deal to fix it back up while we're suing the insurance. And obviously we restructured the deal in the process such that we have way more equity in the deal. But sometimes that's what you have to do in order to maintain and protect your investors, protect your reputation, protect your credit worthiness, protect really everything around it. Most and foremost, your reputation in the market.
Absolutely. You know, the bottom line is investing is not a sure thing. There will be losses, and that's forgivable. You know, if they're out of your control. I'm a firm believer that, you know, the documents will tell the risks. As an investor, you're taking risk. But if you're an operator and you don't want that bad reputation, you don't want, you know, you make it work. Or you're just
actually, I mean, I know our investors are going to get a 100% full return of their capital, plus a very nice, about the 16% a year return on their investment. So there's no question in my mind they're going to walk out of there fully intact with their full promise based on the PPM for promised return. Absolutely no question in my mind. It just took a little extra from our end to make it actually happen. And sometimes people do certain things and sometimes they don't. So
that's incredible. Good for you guys, really.
But I ran the numbers also. I mean, the deal makes perfect sense. It's just somebody needed to step up and finish it up. And since our partner wasn't willing to do that, and therefore jeopardize the deal, we had to step in. But I mean, you do the same thing. You would have done the same thing. I know that's why you're in business for 20 years, and that's why you're sought after in all those different television places and shows and podcasts and so on. That's why everyone you speak on the big stages, and because I mean, as you said, your reputation precedes you. You got to be a good person. You got to be an honest person, and you got to communicate clearly. I 100% agree with you on that.
Yeah, I mean, I that's one of the reasons that multifamily scares me, is because I did syndicate a multifamily deal. The gas pipe broke in the middle of the night. The building had to be emptied. We had to pay the tenants to leave and take care of their housing, and then the city came in and made us do a whole lot of things that were not budgeted for. And same thing, my partner left. I was stuck with it. And I didn't know what to do, but I just plodded along. I went to the bank, said, look, I don't know what to do. You can have this thing back. It was vacant. Had all these issues. And the bank's like, no, why don't we just reduce the loan? They reduced the loan by $1 million. You know, you just, again, got to do what you got to do. So we were same thing. I had to take it over, but I'll tell you what, I don't like old buildings or old multifamily. Ever since then, I'm paranoid. I only like nice new things. And
that works too. Now I like the older buildings. They have great potential, but yeah, you just got to be prepared for some of the things. And that's why as an investor, it's important that you identify what you want to invest in. If you don't like the ups and downs of a multifamily deal that potentially come in, then don't invest in those. If you don't like the single families because of whatever other reason, then don't invest in those. So just or pick the ones you want. If you love single family, then invest in those. If you love multifamily, invest in that, or split your money or so on. Either way. So with that said, you have a few funds, you have a thing. How do people get a hold of you to learn more or to invest with you, or whichever way they just be in contact with you?
Yeah, you can find me at realwealth.com. My funds are at growdevelopments.com. And of course, my show, as you said, is The Real Wealth Show.
All right, wonderful. So with that said, I think let's wrap it up. So let's give you perhaps, while I finish a couple of things up, I want to ask you one question, and that is just like what is kind of the last piece of advice you would give our audience right now?
I would say do everything opposite of what the media is telling you to do. So
I love that one. Yes.
Really, my background's in the media, as you know, as you said, I worked in newsrooms. That was my background, was being a broadcaster and a newswoman. And I know what is involved in the news business. You have to scare people. It's how you get eyeballs. It's how you sell advertising. So the headline is meant to get your attention. Just know that. And now there's more competition than ever for your attention. So they get scarier and scarier with these headlines. So don't listen, because good, savvy investors do the opposite of what the masses are doing. So if you're hearing there's going to be a real estate crash, but you really have the data showing you otherwise, well, then you're playing all by yourself. You're picking up all the apples, right? It's a very exciting time. So trust the data, not the headlines.
Wonderful. I could not agree with that anymore. And don't believe the media. And if the media says, and remember one thing, you don't buy when the market is up. You buy when the market is down.
Yes.
Right? So when the media is screaming the market is down, the market is coming down, it's time to actually study. It's time to learn.
Yes.
It's time to get prepared, because the opportunity is when America is for sale, not when America sells at the top market prices.
Yes.
Right? So with that said, thank you very much for being on the show. I loved it. Again, everyone, thank you very much. This concludes a new episode of the Jack Boss Show. With that said, thank you very much and have a great rest of the day. Bye-bye.